Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of financial updates with your host Shikhar Garg. Now, the market looks to be in a vacay mood as the activity remains low or muted across prior to the long weekend coming in, except for yields. As we can see now, US 10-year yields have went past 2.8%, while the Indian ones have also been trading well above 7.15%. So there's good interest or a route for that matter that we can see in the bond market. Oil also looked steady against its usual moves in the past few days. So Pankaj, can you tell us what exactly should we be expecting out of these yields?
Thanks, Sika. Uh, it doesn't look like that markets are in a weekend mood. It might be taking more clue from global markets, and it will. Uh, we are seeing dollar index back above 100. We have seen a good amount of selling in stock, and we are going to see. We are seeing first time in last 12 years that China 1 year yield, 10-year yield are lower than the US. These are the magnificent shift which are happening across the market. Global stocks seems to have resumed their downward journey after the recent recovery, and selling intensified yesterday with jitters surrounding another probable highest inflation in last 35-40 years, and it's going to be around 8.5% print. And what we are talking about, 10-year US yields at 2.8%. So if people look at the situational thing, it's a huge negative real rate. We know that it won't persist that way. Inflation has to come down, will come down. But these are the significant gap between inflation and yields. Market also took cue from a Chinese market. We saw a hefty fall at fear of stagflation. Let me highlight how the market expecting the next two FOMC meeting going on. They are expecting almost 50 basis hike in both the meeting, and that's awesomely taking entire interest rate curve across the globe higher. The growth stocks, Nasdaq fell by 2.2%. Now earnings seasons are starting, and we will be seeing how this margin is squeezed or banks reporting a good results can stabilize the market. On the war front, there has been no material progress in the peace talk. Ukraine said it's expecting Russia to launch a huge new offensive soon. On the dollar, we saw some brief downfall yesterday when French President Macron looks like beating his nearest rival in first round of election. Pulled down the DXY, but that stayed very for 3-4 hours and then back on higher levels. Surge in yields in anticipation of possible. We already discussed 2 to 3 meetings. We'll have and then along with the balance sheet runoff, we'll keep dollar well supported. And yen is one currency which is taking beating every day. Euro is expected to remain volatile ahead of the second round of voting in France and ECB meeting scheduled this Thursday. Market would be expecting that despite of some recessionary pressure because of inflation, energy prices and all, but ECB should be talking about also higher rates, and this would impact euro in a way. Higher rates in US has also started taking its impact on our commodity prices, including oil and pull down the Canadian Australian dollars in the recent session. One more thing is basically we have seen which is now started reversing the ruble. Ruble weakens sharply on Monday, reversing some of the gains after Russia relaxed temporary capital control measures aimed at limiting a drop in the currency. USD INR had a peep above the month's high with 76.02 with a strong import spike after initial dip to 75.83 due to lower crude prices. Strength in dollar index and rising yield across major economies with the weakness in Asian pressure. We might see that our dollar rupee again might trade above 76 today. We are seeing a range of today's range would be something around 85 to 15, and if we continue to trade above 76.10 in next 1 or 2 sessions, we might see 76.40, 58. Today is CPI data would be released in India, and its expectation that will be between 625 to 640. and this will be the third month in a row above 6% inflation. Indian 10-year yield is now dealing at 7.15, which is almost 30 months high, and which has been pressured by change in communication by RBI, higher yields globally, and expected CPI number. That's all from me. Thank you.
Okay, so I shall make a correction in the statement I started off with. It's not the markets are in the vacation mood, but the bulls are in a vacation mood, as we can see. All the yields are moving up, and we still are seeing no respite. On the other hand, inflation looks to be quite high, friends, and this is what we can see. The releases have been quite high, which can prompt further rate hike actions, as Pankaj mentioned. So let's see how we can get past these risks and manage them well. Till then, we say goodbye. That's it for today. Thanks.